Alright ladies and gents, welcome back to the channel. Now before we dive into the numbers and news that I want to cover in this video, let's just take a step back. If you've been paying any attention to the financial chatter over the past few weeks with regards to the Bank of England and current interest rates, whether that's in the press, online or just among investors, you know that there's been a lot of noise. Markets have been full of anticipation and people have been speculating. Will the bank move again? Will they hold? Are we finally turning a corner? And more importantly, what does that mean for mortgage rates, for inflation and for lender appetite? Well, we've now got our answer. The Bank of England have just cut its base interest rate to 4.25%. That's the fourth reduction since August 2024, a whole point since the peak of 5.25%, and the interest rate is now the lowest it has been in 2 years. And naturally, the headlines are painting this as a win. The economy's cooling off, inflation's coming down. Time to celebrate, right? Well, not so fast. If you're investing in property or running a business, the real impact of this move goes deeper than the headline suggests. So in this video, we're going to break it all down, from mortgage rates and inflation to lender behaviour and the practical decisions you might want to think about next. Let's start with how this decision came about. The Monetary Policy Committee, that's the group within the Bank of England that decides interest rates, wasn't unanimous. 5 members voted in favour of a 0.25% cut, but 2 actually wanted a bigger cut of 0.5% and 2 didn't want a cut at all. They voted to keep the rate at 4.5%. That kind of division tells us this isn't a straightforward recovery. It's not a we've made it time to relax kind of moment. It's a cautious move, a small step forward but with eyes still firmly on the risk ahead. That tension between inflation control and economic support is driving the bank's decision right now. Yes, inflation has been falling, which is good news, but it's still above the bank's long-term target. And nobody wants to reignite it by loosening policy too quickly. So the bank is trying to balance support for the economy with its inflation-fighting mandate. This latest cut is a signal. They're ready to help where possible, but they're not prepared to risk undoing the progress that's been made. Now, when we talk about interest rates, everyone immediately thinks of mortgages, and that's fair, but here's where we need to separate myth from reality. Tracker mortgages, which are directly tied to the base rate, will see the most immediate benefit. If you're on a tracker, expect your repayments to come down shortly. But most homeowners and investors are on a fixed rate deal, and these don't move in line with the base rate in a direct or immediate way. That's one of the biggest misconceptions. Just because the Bank of England rate drops doesn't mean your fixed rate mortgage will follow. So when you see the news interviewing renters who are frustrated that rents are still rising, even though interest rates have come down, it's based on this common assumption, which is often fueled by the media, that lower interest rates should mean lower costs across the board. But what they tend to overlook is that most landlords aren't actually seeing much, if any, relief on their mortgage payments, especially if they're on a fixed deal. At the same time, other costs like insurance, management and maintenance have all gone up. So as inflation continues to push those operating expenses higher, rents naturally follow. It's not about landlords cashing in, it's about staying afloat. Lenders set fixed rates using a wider set of indicators, and one of the most important is something called the swap rate. Swap rates are the rates at which banks lend to each other over fixed terms, and they're a leading indicator of where markets think interest rates are going. If swap rates fall, fixed mortgage pricing tends to follow, but not always at the same time, speed or intensity. There are other factors too. A lender's own cost of funds is critical. If it's expensive for a bank to source capital, for example because of high wholesale rates or tighter liquidity, they'll pass that cost on in pricing they offer to you. And then there's appetite for risk. Lenders operating in uncertain markets often keep rates higher, not because they have to, but because they want to hedge against the risk of defaults. Even operational factors can affect pricing. If a lender is already dealing with a backlog of applications, they may deliberately price themselves out of the market for a while. Rising rates not because of cost, but as a way to control volume. So again, the message here is a base rate cut is only one piece of the puzzle. It's a signal and a potentially helpful one, but it doesn't guarantee cheaper mortgages across the board. On the fixed rate side, movement has been slower Lenders are still cautious, and understandably so. The macroeconomic picture is still uncertain and inflation isn't completely under control. So while we all hope for a new wave of lower fixed rates, we're not just there yet. This is where strategy comes in. If you're refinancing or planning a purchase in the next 3 to 6 months, now is the time to start conversations with your broker, not just to lock in a rate, but to explore which lenders are adapting to this new environment and which ones are still pricing in last year's risk. The product structure matters more than ever. In the current market, flexibility can be more valuable than price. Short-term borrowing, whether that's through a tracker mortgage or even a bridge-to-let strategy, might actually offer a better total return than locking into a longer-term fix at today's still inflated levels. Especially if you're working with multi-unit freehold blocks, semi-commercial units or development-led projects, the right finance can open up options that go beyond monthly cost. For example, using short-term finance to reposition an asset before switching onto a longer-term facility once rates improve. It's also worth considering that the rate cut isn't just affecting mortgages. Business finance is shifting too. For owners looking at asset-backed lending, cash flow loans or expansion funding, this might be the moment to renegotiate terms or shop around more aggressively. Some lenders are using this rate cut as a reason to reposition their offerings. That means new opportunities, but also new terms and structures you'll need to understand properly before signing anything. And while the base rate cut is the headline, the real story is in the underlying trends. Keep an eye on swap rates. These are a window into what lenders expect over the next 6 to 12 months. If swap rates continue to fall, we'll likely see more competitive fixed rate products, but if they stall, fixed pricing will stay higher for longer. Inflation remains the other big factor. If upcoming inflation figures show further declines, that could accelerate the path to more cuts. But if inflation holds steady, or worse, ticks back up, the Bank of England may pause its reductions. And that would create a more volatile environment for lenders. Lending criteria is another area worth watching. In theory, lower interest rates make it easier to lend, but lenders are still cautious. Many have kept affordability stress tests high, and some remain strict on loan-to-value ratios, particularly for investor products. So, while rates may fall slightly, don't expect the doors to swing open overnight. Underwriting remains tight, especially for new landlords or complex deal structures. So, what's the takeaway? Yes, a rate cut is good news. Yes, it's a step in the right direction, but the smart move now isn't to celebrate too soon. It's to reposition, understand how lenders are thinking, look at how products are being priced, and work with professionals who understand this shifting landscape, especially if you're operating sectors like multi-unit freehold blocks, commercial conversions, or anything that relies on layered finance. Because the truth is, the people who benefit most from these kind of changes aren't the ones who read the headlines. They're the ones who understand what's going on underneath and make decisions based on real-world mechanics, not media noise. If you're unsure how to navigate all this, or you're looking at your next acquisition and wondering which route to take, get advice from people who are working with these kind of lenders every day. The right structure, the right product, and the right timing can make the difference between an average deal and an exceptional one. It's not about predicting the future. It's about positioning yourself now so that when the next rate cut comes, or when swap rates shift, you're ready to move, not scrambling to catch up. As always, guys, thank you very much for watching. I appreciate you for being a subscriber, and I'll see you again on the next one.